All right, welcome everyone to another Rocket Dollar educational webinar. We're really excited about this one today because when we surveyed our customers it was about a month and a half ago, inflation has come, markets are really changing all over the place. We asked the customers, what investments do you want? What's the top of your mind that you're really trying to find and research right now? And people said real estate was that top investment. And real estate is always one of the top 3 assets in our platform, with crypto, private equity, and now it's kind of nice. It feels like almost like a few years ago, real estate was on top like every single time when crypto dies down. So I'm really excited to introduce Andrew from Doorvest today. And Andrew, why don't you introduce yourself?
Hey, Brendan, thanks for having me. Hello, everyone. Yeah, I'm pumped to be here. I don't know, Brendan, if you even knew, but I worked at a 401k company before, and from a personal standpoint, have always just been fascinated, intrigued by the world of personal finance. Of course, from an individual level, but also from an investment and a psychological level too. So, anyways. Long rambles short, have always been intrigued by sort of the world of retirement accounts. And it's always been sort of a dream to see how you could kind of mesh real estate investing with retirement accounts. So been way too long, but excited to be here today. Thanks for having me.
Yeah, and a quick summary of Rocket Dollar for anyone who's coming in new to this. We create traditional IRAs, Roth IRAs, and a couple other products like the solo 401k for investors that like to invest in alternative assets. So these are things like individual real estate properties, like we're talking about with Doorvest today, multifamily, self-storage. There are so many different types of real estate. And in the public markets, really you only get like a public REIT. That's the only thing you can access. Real estate investors that are veterans or they're new, they get really frustrated that there's only like a couple of these options that are publicly traded in the markets. So the Rocket Dollar account, we facilitate that retirement account and hopefully get you into an investment that's easy to manage, like Doorvest can help you with. So Andrew, let's just learn a little bit about the Doorvest platform. After that, we really want all of you watchers out there to get involved in the Q&A. Feel free to pop in with what state that you're kind of joining us from, where you're located, because we're going to be asking you, some of these questions and some back and forth with Andrew. So this will be a little bit of Doorvest, and then it'll transition to what we call one of our fireside chats with that interactive Q&A. All right, take it away, Andrew.
Cool, thank you. Yeah, I mean, at a real high level, Doorvest makes it easy for anyone, anywhere, to buy and own an investment home online. So the process is pretty straightforward. We kind of start with customers and their investment objectives. So how much did you have allocated towards real estate, or maybe in this instance, like how much of your IRA funds would you be interested in sort of deploying towards real estate? What sort of returns or risk profile did you have? Like, are we looking for more income generation? Or are we hoping for this sum or this asset to kind of grow and appreciate in value over time, or kind of something in between? And then from there, Doorvest will curate the end investment home for you. So we'll take your criteria, and then on the other side, our team will go out and source homes based on your criteria. We'll match it to you as the consumer. You'll thumbs up or thumbs down it. If you thumbs down it, that's fine. We'll ask for your feedback as to why. That'll help us refine our search, and then we'll keep going until we find a home that you like. Hopefully that we could continue to find a home that you like. Once we lock in a home that you like, Doorvest will then purchase the home on your behalf. We'll purchase it. We'll then renovate it. Our objective, and we could get into the reasons why later, but our objective is to do extensive renovations. So on average, we're doing about 50,000 in renovations on roughly a final home that's worth about 200,000. And then we'll place a resident. So you as the consumer, or your IRA effectively, will sort of then purchase the finished investment home. So you'll buy a home that's effectively brand new and renovated along with a resident. And then it doesn't stop there. Once you close and take title, we'll operate the home. So full service sort of end-to-end management. And then our objective as a company is hopefully we could help you sort of purchase your first ever investment home through Doorvest. A stat I'm particularly proud of is 70% of our customers are first-time homeowners. So hopefully we could partner with you to purchase your first investment home, and then partner with you on your journey as you build out your portfolio and assets under management over time.
Great. Thank you for that summary, Andrew. So a lot of things have been, everyone feel free to ask questions about Doorvest if they come up. I'm sure they're naturally going to come up throughout as we talk through the webinar, but part of why we have these is, one, to learn about platforms, but two, people want to be educated on what's going on. They might be a real estate investor themselves, so they might be newer. So I'd like to lean on some of our partners that have a lot more expertise because they live and breathe this space like every single day. So a lot on the minds of investors right now is, okay, we see some things changing in the market. Some people on this webinar might see that really aggressively. Myself in a north suburb of Austin, I see a lot more inventory. Now you're hearing about mortgage rates changing. So Andrew, could you pop in and just give us a little bit of perspective on what's going on in the market right now and what are different investors kind of speaking about?
Yeah. I guess I'd first and foremost caveat, like, I don't consider myself a macroeconomist. Kind of the focus in my living, breathing hours is around sort of real estate and more specifically residential real estate. So we'll try to comment on kind of what we're seeing broadly. Look, if we flash back for the last two years or so, we could see, and I think everyone's kind of seen all the headlines of these crazy appreciating home values and homes and sort of the cost and the competition sort of up and to the right. As it pertains to kind of the world of, as it pertains to the world and sort of the day-to-day work that we do, home values scale exponentially. So home values went up like this. Rents grow. If one sort of pulls back out and zooms out, you'll kind of see that rents just go straight up and to the right, but it takes time. And so the short of that is, like, rents never catch up to sort of quickly home appreciation. And so what that's led to in recent times is just compressed yields and cap rates, i.e. Your return on investment from a cash flow standpoint has just been compressed in recent time. And then the news headlines as of recently is lots of inflation has driven the Fed to increasingly aggressively increase interest rates. And so not only are customers left with sort of, and real estate investors left with sort of compressed yields, they're doubly compressed if you were hoping to get an investment home with a mortgage, because your interest rate has increased. Home values have not yet softened. Interest rates don't look like they're going down anytime soon, and so yields are even more compressed. That's kind of the lay of the land as of today. And so the question is, like, when does something give? Is it, do home values soften? Do interest rates soften? That sort of thing. I think the answer is yes. And I think most experts would say yes. The question is when. Is it today? Is it 6 months from now? Is it a year from now? And sort of the general impact of that. I don't know. I think there's people much more smart than I that are kind of living and breathing some of these macroeconomic trends. The last piece that I'll comment on, and I think the part that I think is really interesting is once we kind of cross over to this new world, the other side, whatever you want to call it, historically, home values sort of come down. Housing, residential housing specifically, is a utility. So maybe people have sold off their homes, and then because housing is a utility, oftentimes people move into rental housing. So oftentimes rents, they're really sticky. If anything, they might increase in certain markets, but we could kind of get into the details of that later too.
Okay. And we have a bunch of questions that have popped in, so thank you. Okay, Melissa asked, this is the first one. Do you need an IRA to invest in Doorvest? And although we're on a Rocket Dollar webinar, we would love to say, please use an IRA. No, you can't. Doorvest is open to non-IRA investors and has been for quite a while. So Andrew, how long have you been working, with standard investors?
Yeah, we've been around for roughly 2.5 years, a little bit over 300 homes under management, and kind of operational in 3 markets as of today. Yes, the answer, as you kind of alluded to, was yes, you could own an investment home without an IRA, but I think there are sort of doubly compounding effects if one were to purchase through their IRA.
Okay, and Melissa also asked, when you identify a property, will the investor know how much the property will be once it's rehabbed? So I think what Melissa's asking, like, is there a price difference from like identification past all the rehab work? Like, how much does that price change? And knowing that probably depends on like how much work is Doorvest doing on the actual property.
Yeah. So the short answer is that's kind of our job, and actually the part that internally we have to get really good at is that when we identify a home for a prospective customer, the customer signs for that home, we commit to future value of this home, including all of the renovation, and we outline all of that line by line of all of the work that all the work that we're going to put into it. So the consumer is locked into the price. On the other end, we as Doorvest have to continually iterate and get better and better at our ability to manage renovation and manage everything in between. But the consumer is insulated from sort of that risk.
Okay. Yeah, and this is more of a complex IRA question, but we'll just meet it up front because someone asked it. So anonymous attendee, I'll handle this one, Andrew. Is there UBIT or UDFI impact if an IRA or Roth IRA money is used? And that would be yes, if you get financing for a property. So if you would buy a property outright through an IRA, it's pretty much almost entirely tax-free. You don't have to worry about any taxable impact. Now, if you're going for all cash, you're going to need, is the property $250,000 or $300,000? That for a retirement account, for some people that is easy, and for a lot of people that's a big challenge to pull out that much cash at one time to buy a property. So the answer is, if you do not get financing, there should be no UBIT or UDFI impact. If you do get financing, Rocket Dollar, we can talk with Andrew's team and make sure you're connected to a non-recourse lender. There's potential that you could get UBIT there. Usually you can try and write off some of those expenses with an experienced CPA. So we could refer you to one. And for anyone, we're kind of throwing a complex topic really early, like what is UBIT? Unrealized business income tax. We're like jumping right into it. It is like kind of the one tax in retirement accounts that it's so you can't hide certain activity in a retirement account or charity. So that's a government tax and saying, hey, this is mostly tax-free in your retirement account, but there's just a few areas that we have to still tax something. And going out and getting a mortgage that's one of those areas. So I would say if you're concerned about that, you kind of get excited about a certain property, a good thing to figure out is, well, how much financing will I need? And then we can always recommend you to a CPA. And the good thing about talking to a CPA is not always what is the UBIT impact, but how do I write this off? Can potentially use some of the expenses coming at you as the investor and write that tax right back off again. All right. Okay. So Cal asked, Andrew, what markets are you active in?
Yeah, thanks for handling that previous question too. I mean, this is why we love partnering with experts in sort of their domain and space. Yeah, I mean, in terms of the markets, we're operational in 5 markets as of today: Houston, Dallas, San Antonio, Atlanta, and Oklahoma City. We're about to kick off another market. It's one that's been popular for real estate investors for a little bit of time. So stay tuned. August 1st, I think, is when we're going to kick off the next market too.
Great. So continuously expanding to a number of states. Just so like Rocket Dollar is based in Texas, so we love talking about the Texas market, but it's almost gotten like some parts of it have gotten so expensive that we see all this growth in other areas now, where 2 to 3 years ago, like all anyone wanted to talk about was Texas, Austin. So yeah, good to see that you're still taking advantage of Texas and expanding to other markets.
Yeah.
Cal also asked, what is your fee structure that you work with investors on?
Yeah, and maybe just taking a quick step back on that too. I mean, ultimately, like our hope is to be able to build out a diversified strategy for customers. And so not only are we looking for maybe the market that's going to appreciate the most, but we're also looking for markets that have healthy income streams. And then depending on sort of customer investment objectives, like maybe you have really high appreciating homes in Austin, great. You should keep those and hold on to that. But maybe you also want to sort of hedge that with some income generating homes that maybe have less upside potential, like hopefully Doorvest can kind of support on that front too. Yeah, right. So to the question around fee structure, yeah, so twofold. That the long term is or the focus is to align our incentives with that of a long-term focused passive investor. So everything leading up to the purchase of a home, we're targeting about 5% in contribution margin. And so back to, I think it was Melissa's question from earlier, when you look at a home that Doorvest shares with you, this includes all the costs, including our renovation costs, including the margin that we're hoping to make from the value add real estate. For context, historically, our average home value is about $200,000, and usually it's a 3-bedroom, 2-bath, 2-car garage. Obviously fluctuates depending on the home and the specifics of the market, et cetera. And then after that, we charge a 10% property management fee. Pretty standard stuff, with the main caveat being we only charge this if and only if the home is income generating. So back to the theme of aligning incentives, we want to make sure that you get a home that you love, you are generating rental income because that's quite important for an investment home, and then we should, and then hopefully we we build our business off of that, and then hopefully as you save up for more, et cetera, or once you're comfortable, you continue adding to your portfolio over time.
Great. Okay. And just so you know, the audience, we're getting a lot of great questions. That's awesome. We have a few prepared questions that we're just going to go through, but trust me, we'll go back and kind of get some of these awesome Q&A questions. So, and one comment I really liked, think about the goals of yourself as an investor. Andrew mentioned passive income. We have some older clients that they think like, I need to live in an inflationary environment. I need like a really steady paycheck. So they love this, real estate investors in their 50s, because they're like, they're looking in the next 10 years, they might need a steady paycheck as they're retired in their 60s or 70s. They want to see that consistent dollars coming in every single week, where some of our younger investors might be trying to take like bigger swings. They might be excited to go to, they might click thumbs up on a property that, that high appreciation, that kind of crazy market. Would there be more like rent competition in those markets, Andrew?
Yeah, again, really varies from market to market. So actually, maybe we could take two examples, at least from the Doorvest lens, and then obviously there's a world and plethora of markets outside of where we're operational in. But maybe I'll take Atlanta as kind of one market that we're operational in. The average home value is much closer to that $300,000 amount versus like that $300,000 amount versus that 200, which is kind of the average for Doorvest across the board. You get really great homes, really beautiful neighborhoods, but maybe at the cost of potentially some yield that you're getting in the short term. Like your absolute yield, like the rental amount is higher, but it doesn't catch up to kind of that $300 sticker price of that home. Conversely, well, we're also operational in Oklahoma City, for instance, and the average home price there is probably a little bit closer to the 160, 170 range, but the rent to price ratio, it's much higher, and so those are kind of the I guess the barbell of the spectrum, and then there's everything in between, and then within a given market, there's also individual homes that meet different criteria.
And to be clear, I know we talked about it probably earlier, but who's actually owning this home when Doorvest is like kind of helping you through this process? So after all the closing, is the actual IRA going to own the home, or is Doorvest owning part of the home?
Yeah, this is an intentional decision we made quite early on, was for the consumer. So the IRA, like Brandon Walsh's IRA, owns the home entirely. Doorvest does not maintain an ownership stake in the home. And so not only, hopefully, are you sort of generating great returns from owning an investment home, but at the end of the day, you yourself have this physical asset.
Yeah, and you're getting all that help from Doorvest. One of the things with IRAs is if you're like a first-time IRA investor looking at real estate properties, is the management gets a lot harder because you really cannot do it. So in a crisis, even if that property is in your backyard, is the IRS going to default you for like fixing a fire or fixing like an emergency? No, but if they find out you're continuously going to the home, spending your own time and sweat equity into it, and you are basically getting kind of free labor from yourself, they could consider that a prohibited transaction. So a platform like Doorvest having that property management really helps to be able to kind of get rid of that prohibited transaction risk or potential conflict of interest between yourself and your IRA. Okay. So Brian had a good question. Are the properties generally single family residential units? Or are they other types that can be bought, like multifamily or commercial?
Yeah, great question. So the vast majority is single family, usually, and the average home, I think I kind of mentioned this earlier, but the average home is sort of a standard 3-bedroom, 2-bath, 2-car garage, really homogenous sort of type of supply. It's kind of the average. Of course, from time to time, we'll have small duplexes or small multifamily. I think the highest we've gotten to is a triplex, but I'd consider it the vast majority as single family. The intention with that is, one, to keep the capital barrier lower. It probably goes without saying, but like you're able to buy a home for less because it's a single family home versus a big structure. But secondly, I think the strategy that most of our customers have sort of employed is it gives you a little bit of physical and geo diversification too. So instead of buying one 400K multifamily, maybe you could buy 2 or possibly 3 single family homes across maybe a couple of different geos.
Okay. Yeah, and so one attendee asked, and I think this question will vary depending on if you're doing with an IRA or yourself, but can you eventually choose to stop renting the home and live in it yourself? So let's just talk quickly about the non-IRA case, Andrew.
Yep.
Okay, you could.
Oh, yeah, I think you probably we'll leave it up to the experts on the, or sorry,
yeah,
you said
IRA,
that. Yeah.
So with an IRA, you'd have to be very careful with that. I would like to, this investors, you almost hear like an emotional attachment. Like, I want to invest in this house in my IRA, but I love it. It's in this area I absolutely adore. I know it's profitable in money sense, but I'm all, you can tell they're getting a little emotionally attached to it. If you do not distribute the IRA, meaning like you have to pay like all the taxes on it. So that would be like a financial hit to you. That's the only way you could possibly clear yourself of the prohibited transaction risk. If you do not do that, very expensive process of kind of going and paying all of the taxes, you basically have a very high, like extremely high prohibited transaction risk. If the IRS finds out that you had this had this home in your retirement account, and then suddenly you are living in it, or your spouse is, or your kids are, or your parents are, they could potentially blow up your IRA, and then they can give you an early withdrawal penalty. So once you buy a house through an IRA, a general rule of thumb is thinking, I am never going to live in this property. That's a really safe way to think about it. If you have an emotional attachment to a certain home, or if you can see yourself one day, like, I think there's a strong chance I might live here or love to live here, definitely buy that in your non-taxable side, save your IRA money and go buy another property that you are not as emotionally attached to, so you don't have to worry about that risk. Okay, Josh asked a question about lenders. So again, Josh, we'll talk, who's asking this question, we'll talk about it quickly from the non-retirement side, and then we'll jump in how the retirement side is a little different. So Josh asked, do you have preferred lenders? Do you also work with lenders that maybe offer like unique loans, especially in these times with high mortgage rates, like ARM loans or interest-only loans to boost cash flow?
Josh, good to hear from you. So the short answer is yes. We work with a number of lenders to provide various options. Again, the intention is to match kind of the lender and the investment strategy with customer investment objectives. So definitely a gambit of conventional lenders that are doing 30-year fixed, and some folks that do ARMs where you could get lower interest rates to begin with, and maybe it becomes adjustable later. And then other folks that do portfolio loans for some of our customers that are quote unquote sort of power customers that own too much to be financed with conventional lending, et cetera. In terms of the IRA specific lender, I think I'll pass it back to Brendan. There's a number of folks that we've spent some time with in the past, but I definitely think Rocket Dollar has a stronger lister.
So you'd have to get what's called a non-recourse lender. And what's different about that loan? Some people also like to go for like hard money loans. And the difference there is with a traditional mortgage, imagine like, let's forget about Doorvest and Rocket Dollar. If you mess up on your traditional mortgage, what can the bank do to you? Where can they inflict pain because they need to pay themselves back? They can go after possibly your current house, or maybe you and your spouse's car, or like any assets that they have recourse for that they need to be made whole. So when you see like foreclosures, that's the recourse the bank is taking is we need to repossess this house so that the bank doesn't run into future trouble if we lose a couple houses or from bad payments. So a non-recourse loan, the bank can go after a variety of assets to make themselves whole. With a non-recourse loan, the specialized lender can really only go after the property itself. So let's say through your IRA, you bought one property through Doorvest and something happened with your IRA, you had a crisis or something, you had to pull a lot of money out, you could no longer pay the specialized lender. They would not be able to go after your personal house or your personal assets, and they would only be able to take that property that they kind of agreed and signed at the beginning of the contract. So their recourse or damage impact, they can only go after a certain amount of assets for you. It's really very specific. So how does that vary from the bank side of you? Some customers go, well, this is great. There's low risk for me. Well, the bank also says, hey, because we can only go after this one property, this investment property, we can't go after your personal home or cars or anything else. We need to change the interest rate a bit because we're taking a little bit higher risk. So the bank usually will have a couple percentage points higher to go after to give that loan to you. Now, Rocket Dollar has a couple specialized lenders that we can refer you to that know the space very well. And they also know how much risk it is to buy a house in a retirement account. So if you can work out a really what's called rent ready property, meaning like it doesn't need a lot of work, it's going to be rent producing right away, you can try and get a really good deal from a non-recourse lender because the bank knows, hey, seems like Doorvest has got the property management covered. Seems like it was recently renovated. Those are two huge size of reliefs from the bank's point of view. So they know that they're not walking into a really troublesome or potentially risky situation on the house. So that way, hopefully they don't have to charge too much more than a standard mortgage rate out there on the market. If you go to a standard bank and just ask for a non-recourse loan, they might not know what it is. So make sure if you're confused or if you're having trouble with the lending, please talk to Rocket Dollar. We will refer you to certain people. The other avenue is just hard money lending. And that's a lot more like, Andrew, that's very network heavy sometimes. Like you got to know the right people. So some investors love that type of investing. They closely invest with a lot of different networks. So that's very like relationship based. Sometimes the average investor could struggle to get that. So if you're having trouble finding a lender, please contact Rocket Dollar or Andrew's team. We'll try and get you a specialized lender for the IRA if you're going the IRA route. All right. And we just talked a lot about mortgage rates, Andrew. Like let's maybe speak a little bit broader about how mortgage rates are changing. For the quick 101, as the Fed raises interest rates, they're kind of making a monetary policy decision. They feel like there's too much cash going around. You hear all these inflation is transitory last year, and then the anxiety got higher. Actual inflation started getting really high. So the Fed started saying, hey, we need to tighten the amount of money kind of out there in the system. So instead of like, I was very lucky, I got like a below 3% mortgage on this house that I'm in right now. That's not available right now. So Andrew, what's happening in the broader market with these mortgages?
Yeah. I mean, bless you on that, and bless all the folks that kind of locked in the low interest rates. I mean, from a speculation standpoint, I think this will be interesting to see what these low interest rates kind of do to like housing supply over time. Like you got interest rates that are, I mean, a fraction of where the market is today, and you lock yourself into that, I'd be curious what motives would drive people to actually relinquish that through sort of like selling their home, et cetera. In terms of mortgage rates in general, I mean, you kind of said it better than I could have said it myself. Like the Fed, the Fed has one major tool to combat inflation, and that is raising their interest rates, which has sort of this waterfall effect in all lending across kind of the world, actually, since the Fed is the largest central bank in the world. And so how that impacts mortgage rates specifically is that as it pertains to mortgage rates, oftentimes mortgage rates tend to be forward-looking. So banks and lenders are looking at and predicting where they believe that the Fed will raise interest rates, and then they'll factor that into their pricing. Their pricing is effectively their interest rate in general. And so, I mean, I saw something in the comments around like roughly 7% or so in investment home mortgages. That's definitely within range of what we're seeing. I think the average we're currently seeing is 6 or 7%, and that's probably up from 3.5, maybe 4 or so, but before sort of the interest rate hikes started taking effect. I'd say the last piece and where are we going from here? It's very complicated. It's much broader than just interest rates or just economy or just housing, et cetera. But I think if there's one major thing to look at, it's just how is inflation doing? Because if inflation continues to go up, the Fed's number one job is to bring inflation down. And the way that they're going to do that is through raising interest rates.
Yeah, and so that's why you see in the news, it's the stock, people are like, why is the stock market going up? I just heard bad news, you know? And what people are looking at is they're almost hoping the Federal Reserve is able to hurt the economy enough that inflation can like cool down. So like when people see like, oh, there was some job growth was slow, you see like a weird, like people are almost cheering for it because they hope that we can avoid like a big recession by, if we see some things in pulling back, okay, we've defeated inflation. The Fed doesn't have to punish and just beat us with the stick of raising rates anymore. That's like what kind of people are hoping, and they're really watching the news. So, you know, you'll see those market updates and you'll see the stock market react very strongly to those moves. And then Andrew, when mortgage rates responded like very strongly, there was a couple weeks even where mortgage rates changed very drastically. The Fed will make their moves, but that is individual banks and lenders, correct? That are making those decisions.
Exactly. So it doesn't have necessarily a one-to-one correlation. So the Fed rate does not directly impact your mortgage rates, but based on that and based on the cost of banks and lenders borrowing, they'll factor that into their pricing. And I think we're probably talking about the same time period. Maybe this was like March or April or somewhere a handful of months back, where the rates were just going through the roof, and actually was caught right in the middle of that, where I didn't lock my interest rates right before that. There was like this like the mortgage rates went up like a full point or something of that nature.
Yeah, and so this is, you know, I think it's good for clients sometimes to understand. They see these numbers moving, but they don't always know like who's making them move. So like inflation is driven by people spending, like people have a lot of money. They're excited to come out of COVID lockdowns. They're spending on luxury stuff because they've got cash in their bank. They're excited their job is doing well. They're spending a lot of cash. Maybe they move to a new economy, you know, they move to Austin, they move to some hot new place, so they're spending all this money. But when that reaction came from the mortgages, that's actually the lenders looking to the Fed and say, okay, we have to prepare. If we're offering, you know, 2.9% rates or 3.1, and the Fed raises rates a lot, we're not thinking ahead. Like the bank might have more trouble because they're leaving money off the table. So the banks and lenders are trying to adjust. And, you know, a lot of people ask like, well, where is this going? That's obviously every bank lender and every real estate investor would love to have the magic ball to predict that, but we don't know. So what can you do to prepare for that? So Andrew, what would you say like investors can do to be active if someone's interested in real estate they might be seeing changes in the market. They might be looking for opportunity. What could an investor do right now to be proactive and kind of searching for these deals?
Yeah, I think it really depends on the investment objective. So I'll try to just comment on that sort of the blanket answer. I think first and foremost, really starting with and really scrutinizing what exactly are your investment objectives. Of course, everyone wants the perfect investment, which is like really affordable home, great income potential, zero risk. But the reality is there's consistently, and the markets are very the markets are very efficient, where there's consistently a risk and reward trade-off. So being hyper clear about what your investment objectives are, and then sticking to your guns there. If we're focused on income, let's focus on that. If we're focused on a long-term buy and hold, then we should forget sort of the news headlines and some of these day-to-day ripples and things that come up as that shouldn't have a major impact. If your investment horizon, like your retirement account, if your investment horizon is over the next 20 or 30 years, et cetera. So I'd probably start with that as just being hyper critical about what your investment objectives are, and then why. And then after that, using diligence and on your numbers too. It's like, if my focus is to buy X home, really make sure that this investment or this home, et cetera, matches up to your criteria, and has the ability to weather some of the storms that might be ahead.
Yeah. And I think, speaking about my own personal experience, is good to share, like, okay, investors, they often ask, like, okay, Brendan, you were a financial advisor, like, what should you do? Like, not financial advice, but just some good habits to have is, like, if you're thinking about investment, one, research, or like reading content, like, glad you people are here, you're listening into updates about the real estate market. That can get you at a better sense to figure out what your investment goals are. If you don't know, just kind of like listening to a lot of content, like, that might become more clear. Like, I had an investment goal, like, I'm going to beat inflation. Like, that was mine all spring. Like, I'm going to beat inflation. I'm going to beat inflation. And you know what? Like, I made a couple mistakes. All as the market was like kind of chaotically going down, I was investing in things thinking like, I'm going to beat inflation. And then all of a sudden, like, that was a huge mistake. So like a lot of other investors now, I started thinking like, okay, I need to stop worrying about the short-term risk of inflation. I need to not make a stupid mistake and kind of willy-nilly just fire off in different areas. I need to kind of accumulate cash for after I figure out what my investment objectives are. Once I figure that out, what's the first step to that I can be proactive and do now? I can accumulate cash. We actually have a lot of rocket dollar investors like accumulating cash right now. So they're in like maybe they were in a little bit of panic a few months ago, but they've been in kind of the planning phase right now. They're trying to think, okay, I'm slowly getting cash because when that investment opportunity comes, I want to be ready for it. So, that could take 2 to 3 months between selling assets, preparing for it, kind of thinking about what you want to do, what markets you want to invest in, and what are your really goals. Just don't get too intimidated by it. Just think like, what can I do this week to make a little bit of progress on that? Is you're attending the webinar, you're doing a good habit. Maybe you're watching this later on YouTube. Maybe you're sell a bad asset and say goodbye to it. I did that to a few that said, I don't need these anymore. That didn't really fit my goals. I made a mistake. Maybe I took a little loss on that, but now I have cash to kind of deploy to things when I'm calmer and being more strategic about it.
Yeah.
So
just to comment on that really quickly, I think you hit the nail on the head on something I wanted to just triple underline, is around sort of the be able to walk away from things as well. And the way that you're often able to do that is having a level of diversification, sort of the old adage of like not having all of your eggs in one basket. So invest and diversify, so that if for whatever reason your thesis doesn't play out according to plan, I don't think any of us here have the crystal ball. And sometimes in sort of the world and the landscape of investing, maybe you had a thesis and it didn't pan out for whatever reason. Like be able to walk away from that too. And the way that I think you are is you're able to diversify and kind of spread your assets and wealth across a number of different vehicles and things of that nature.
Yeah, and the diversification again was proven true the last 6 months. So like investors that were very heavy in tech stocks and crypto, which was like the highest flying asset of the last year and a half or two, That was pretty punishing. Frankly, like that was me. I took some like huge L's over the last 6 months. But compared to investors that were much more widely, there honestly wasn't a lot of places to hide in the last 6 months. But if you were outside of just tech stocks and crypto, you had a lot better time. You were seeing 4 or 5% drops rather than 20-30% drops in your portfolio per day and per week. So that diversification, you might have still gotten hit too, but if you're out in a lot of areas, as in this post-inflationary environment, and we're going to start talking about the R word, the recession word next, how can you take advantage of that? You might not know what's going to explode. So if you're diversified, you might be able to notice, hey, 2 of these investments are doing fantastic. I see they're really kind of leading in this new environment. So that diversification will help you recognize that as well. So the scary recession word that is being debated kind of in the national media today, are we in one, are we not in one? Let's talk about real estate in a recession, Andrew. So how does real estate, and we'll kind of focus on more of the single family, maybe small multifamily homes, act in a recession?
Yeah, I guess just kind of the 101, as you did earlier, is a recession. At least the technical definition is 2 quarters of consecutive GDP decline. That's kind of like the sort of the textbook definition. Of course, if everything goes down for, I don't know, 1.5 quarters, I think we would more or less round it up to recession, et cetera, is my general thought there. In terms of housing and residential housing specifically, during a downturn or recession or whatever you want to call it, I think maybe we alluded to this a little bit earlier, but ultimately, housing is a utility. So people generally need a place to live. And I think that's where housing has historically been relatively resilient to recessions and downturns. So sometimes, and not always, but sometimes, including the 2008 recession, the great financial crisis, home values came down. And then again, you kind of look at rental values, and you'll kind of see they were, for the majority, sticky across the board. If anything, they even increased in certain markets, et cetera. And so what we believe to happen during a downturn is home values will come down, rents are sticky, and if anything, they increase. And so you're, as a real estate investor, your yield should continue to go up because your cost basis is fixed, and your rents are the same. If anything, they increase.
Yeah, and as investors in this time, you almost have to, you need to think a little bit longer. Don't be, let's say you bought a real estate property and the home value went down like a ton. Think about the long game of your investment objectives. Like, how long are you going to be holding this investment? Or is it 10 years? Well, stop worrying about what happened just like over 3 months. What's the bigger story right now? The rents, the thing that's actually I need to be getting every month, is still consistently coming in. That's still productive for me. If the economy changes again, that home value could obviously come right back up again or change. But think again about what was your investment objectives when you entered this investment. How long am I probably going to stay in it? And worry about those things, those tenure things. Think like very long-term future. Like, well, I might see like a really brutal thing on the statement, but that will come back. This is here presently now. I don't need to worry about that for another 5 years. So let's stop sweating that.
Yeah, I mean, just to comment on that too, like if you extrapolate it over a long enough time horizon, like home values go straight up into the right, rental values also go straight up into the right. If you zoom in, you kind of see the ups and downs and the blips and things of that nature. And the same goes true for things like index funds and retirement accounts and all of that as well. Like if we zoom back out, depending on your assumptions, I think the common wisdom is that the stock market goes up on average about 7% per year. That doesn't mean every single year it's consistently going 7%. Maybe one year it's up 20%, the next year it's down 10%, and then over a long enough time horizon, it averages out to 7%. And so if sort of the historicals are any indicator, that's kind of the general belief is that these investments are meant to be a long-term hold.
Okay. I have a question, but I'm going to ask something to Andrew first to help answer it. So Andrew, what's like you said $200,000 is around the average price of the home on the Doorvest platform. What's the lower end that you typically play in? And then I'll answer a question someone had.
Yep. Average home value is roughly $200,000. Again, it's a 3-bedroom, 2-bath home with a garage. And then it kind of ranges. There's sort of a band. I think on the lower end, we're looking at about 170,000. On the higher end, somewhere close to 300, maybe 320 or so.
Okay. Yeah, I wanted to, some investor had a follow-up that says, they might only have like $6,000, $12,000 in an IRA. And they're thinking, this is a common question at Rocket Dollar because, Robinhood has kind of democratized like small dollar investments and stuff like that. And they think like, hey, I really do want an individual property in my IRA, but how do I get there? So to answer that person, you should keep contributing each year, hopefully. Just keep trying to contribute $6,000 per year. Or if you have a 401k, always hit the match on your 401k. It's like basically free money as far as like Americans making financial decisions. Foregoing your 401k match is like considered one of the dumbest things you could possibly do. You should only forego it if your family's in an immediate, really big crisis, or just something super big financially you need to take care of. After that, you should be contributing again. So a lot of our investors, when they're trying to buy like their first real estate property, this is what they'll do. They'll try and acquire enough for a down payment for a non-recourse loan. So for that, if you need you'll need a little bit more down, but if you can get 20, 30, or 40% down, the non-recourse lender will usually discuss it and be open to that discussion for you to buy a certain property, especially if the property is, as Doorvest is helping to make it, recently renovated, rent ready, in a good, strong market. So a lot of our investors will keep contributing to their IRAs each year. They'll keep contributing their 401k each year, and then maybe they'll leave a job. All of a sudden, that old 401k money suddenly becomes accessible. They'll roll that to an IRA. So they maybe only had like 18 or 6 grand in that IRA. Suddenly a $25,000, $30,000 401k comes over. Once you get that, if you're getting, 30, 40, 50 grand in an IRA, that's where buying an individual investment property becomes much more achievable. So we have a lot of Rocket Dollar investments on the platform. I would say if you're like feeling like you really want to work with Doorvest, but you can't right now, keep trying to save diligently each year. Keep trying to just preserve capital each year. There are some other like smaller real estate investments that you can do if you can't hit that limit right now. But once you get control of your own real estate property, all of that rent money, coming to you, Doorvest helping take care of the property management and the possible appreciation of that property inside of an IRA. If that property is sold in a couple years, 5, 6 years, or if you're keeping it for 4, you're going to have no capital gains with that investment. So to summarize that, keep saving, look to old 401ks, and also, Andrew, have you ever done like where someone's going in together with another investor, or is it typically just one investor per property?
Yeah. So, I mean, this is definitely from the Doorvest direct standpoint. I'm unsure, and you could tell me if you're able to do an IRA ownership with a partner or not. Yep.
You can do 2 IRAs. They just cannot be family members. So a lot of people love to invest with their brothers or sisters, which is permissible. They love to invest with close cousins, or they love to invest with like a close business partner that they know and trust. And frankly, like they might have dabbled in some real estate investing with this person, and they kind of really know and trust this investor. Because just think, you might not be married. You can't invest with a spouse with an IRA, but like you're going to be married with this house property together. So you can join 2 investors together to buy a property through an IRA. You can have 2 IRAs come together. Just make sure it's not your spouse, your kids, or your parents, because that's too often people want to ask and invest with first. You need to think outside the box and think who's in your trusted network outside of those people.
Makes sense. Thanks for that. Yeah, I mean, I think your IRA investment and your retirement investments might the average one probably outlast the average American marriage for better or worse. But yeah, I think to your comment, we've definitely had quite a few sort of customers that have partnered with a friend or a close associate or something of that nature. So that totally works with us. I actually didn't realize the piece around the IRA. I think that's really interesting as well. And so I think the ultimate initial question was around, maybe I don't have enough saved up right now, and with sort of the low contribution limits, how do I get there? Well, one, I think, as you mentioned, was like, and first and foremost is like focusing on what you're hoping to accomplish and working backwards from there. Number two, maybe you could get financing. And then three, if you don't have enough, then maybe you can find a close associate or a friend where the both of you could come in with your IRAs together.
Great. Yeah, it's a common question, but I think it's almost like a multi-year goal. So that's, again, how can you be productive? Think about it now. Is it 3 or 4 years that you can get to enough for a down payment? If you start on that now and you're preserving capital each year, then maybe 2 to 3 years from now, that'll be achievable for you. And that's great to kind of get your feet wet into a real estate investment like that. All right, let me check the Q&A question. So someone asked, can you contribute the total down payment to an IRA in 1 year? So this is you can usually only contribute $6,000 to an IRA. If you are self-employed in any capacity, meaning like you have a side consulting business, you have a side business that you run, if you are a 1099 employee, you can open a solo 401k. Now this can invest in, a property. It can invest in a property through Doorvest. So you, as the trustee of that plan, you can take the trust money, you can contribute well over $50,000, sometimes up to over $60,000 to a solo 401k. So if you're trying to accumulate a lot in 1 year or a short amount of time, I would consider a solo 401k. We even have some clients that have a small side business that's could generate revenue, or maybe frankly, like they're doing work for friends for free. And it's high time their friends are like, you got to start charging for this. Like, you're a great employee consultant, like you have to. So they will start a small business and a solo 401k as a side business. They'll dump tons of money into that in 1 year. And that's how some of our clients, they're like, I'm behind. I can't buy that real estate property right now. They'll do 1 to 2 years in a solo 401k. They'll accumulate as much as they can. And then that is all in retirement dollars. If you are not self-employed, if that's just not your lifestyle, you're at a corporate job, you love your job, keep hitting that 401k. You can ask your job if it's possible to roll your 401k out. I'll let you know it's usually very difficult, and they usually throw up a lot of annoying red tapes and restrictions around that. If you do not like your job currently, or you just recently quit your job, your 401k is immediately available. So we had a lot of people in the last 2 years, COVID just kind of upended a lot of people's situations. And all of a sudden they said, hey, my 401k is suddenly on the table. I'm going to finally jump into this investing that I really have been held back from before, because it was locked up in my corporate 401k, which has probably got some great index funds from hopefully from like Vanguard or Fidelity and low fee stuff in there. But some people's 401ks, I used to work in that space. Andrew, you did. Some people's 401ks, cringy, terrible, high fee investments, like not even good in the stocks and bonds and mutual funds front, not at all. All right. Okay, this is a good one. This is really recent, been in the news, I think. How do you see the continuing impact of federally imposed eviction moratoriums in the name of COVID? So that, just so people know context of that, because the pandemic was kind of upending things economically, the federal government made it harder in some aspects to evict someone from a home. And that was, just a prime conflict between landlords and tenants of the last 2 years. So Michael asked, do you see more foreclosures on landlords coming up, or more inventory becoming available because of this?
Yeah, great question. I think I'd say I'm going to answer this pretty generically, because I think the important part is this very much varies from municipality to municipality as well, and much of it is sort of, at least at the sort of the federal level, is weaning off, given it feels like we're kind of on the tail end of COVID, et cetera. I'd say first and foremost, as it pertains to Doorvest, we've consistently focused on markets where some of these laws and sort of the general housing laws lean sort of owner side. That's probably the high level answer. I think the more important one is that number one, it's in everyone's best interest, including the owner, including the resident, and including Doorvest, to find a way for this to work. So oftentimes this becomes sort of like a discussion versus sort of a blanket answer, like a yes, no kind of thing. And then I'd probably say number two is around sort of around the piece around foreclosures, et cetera. I think it'll be less so about like folks with income generating homes, potentially folks that maybe can't afford their mortgage for their existing mortgage on a primary for whatever reason. That could be the case. That's of course historically what happened during downturns, and so there's a possibility that maybe supply or inventory sort of opens up a bit. That's certainly a possibility. I think the one piece that is different this time than before, or two pieces that are different this time than before, is just the subprime lending that heavily impacted 08, 09, the great financial crisis. Like that stuff is pretty, I mean, it's really low compared to how prevalent it was before. And secondly, sort of the housing constraints, like the amount of building in recent years as a direct result of GFC is way down. And so like housing supply in general is just much lower than it was before. So lots of factors to be considering, and around sort of the evictions and whatnot, very much city to city.
Yeah, we're still seeing reverberations of 08, even now in 2022, of the crazy just build everything, like that has been pulled back a bit. And we're now seeing the consequences of, I'm in a house now with, the families moving in with the family and everything. And it's just space demands for work from home offices, people living in different areas. We're seeing so much of this more housing demand, but we're scarred from 2008, where people were not building like gangbusters, which would almost have been a huge benefit if that was going on for 5 years right now. Okay. So we have one more question we're going to answer. If anyone has a last question, you can try and put it in here. We're almost at time, so we can try and answer this through email afterwards. I'm going to get to this question, then we're going to talk about our codes, Andrew, that we have an offer for everyone on the webinar today, or if you're watching on YouTube later. So someone asked, is the solo 401k subject to the $20,000 contribution threshold? Is it merged with the 401k at your employer? So if you have a side job and you have a W-2 job where you're doing your 401k, you can contribute almost $62,000 if you hit like all the boxes. You contribute well over 50,000 if you hit all the boxes, or if you're older, you can contribute even over 60. But you have to make sure you don't double dip. So if you already put like 15 grand into your 401k at work, you have to be careful you don't overdo it in your solo 401k on the side. So what we'll have a lot of people do is they'll contribute to their match at their employer, and then them or their spouse might have an awesome side business they're running that's doing well. They'll contribute the rest in their solo 401k, but they probably have to go talk to their CPA and make sure that they don't, if you stack the two on top of each other, if you go over the whole 401k limit for the year, the government could step in. That could be a potential audit risk that you'd have to fix. So feel free to contact Rocket Dollar about that, and then we can refer you to a CPA if you really need advanced help on that. Okay, Andrew, let's talk about the code and offer that we have. So we have two, one on the Doorvest side and one on the Rocket Dollar side. So why don't you talk about the Doorvest offer that you have going right now?
Yeah, I'm just ecstatic about this and kind of our ability to work together and sort of kick off this formally. So yeah, on the Doorvest side, it's a pretty straightforward offer. So for customers that go through and submit a deposit, and as a refresher, deposit just means that you put down a deposit and Doorvest helps you begin sourcing. It's fully refundable. You could take a step back at any point if it doesn't match or if your investment objectives change, etc. For anyone who submits a deposit, please use the promo code ROCKET. So ROCKET as in Rocket Dollar, ROCKT, for a waived deposit fee, along with $500 in maintenance credits for once you you purchase your home with Doorvest.
Great. And as always, as part of these webinars, we just like to give a discount to the people coming in from the Doorvest audience. Or if you're like a fledgling Rocket Dollar, you're interested in becoming a customer, you can use the code Doorvest for $50 off. And that just also lets you know that you're excited and interested in the product. So we can see that, and we get to do more great content with Andrew's team. They've all been great as we prepare this. We're probably going to do a couple more things, Andrew. We've already talked about some more content that we're doing. So first, we're at time. I'd love to thank everyone that popped in the Q&A. Sorry we didn't get to talk to every question live, but we had Chris from Doorvest and Nick from our side, trooping through getting over some COVID right now. He's answering questions in that chat for everyone. Andrew, thank you so much for coming today. And any just kind of closing comments for the audience out there?
Yeah, probably second to kind of what you just mentioned now. Like, thank you all for showing up, and this was a lot of fun. I feel like we could have gone on for hours, but maybe we would have put some people to sleep at some point. But I'm excited to be continued. I know we have a lot of things planned ahead. Yeah, see you again soon.
Thanks. We will see you again soon. You can check out, we had a podcast with our CEO, Henry Yoshida, and Andrew that just released about a month or two ago. And we have some other content planned in the near future we're very excited about. So thank you. Thank you, everyone. You have a great evening.